landmark event in the financial services calendar in Brussels, attracting attendees and speakers from all over the European Union. Obviously, any good conference requires both high-quality speakers and topical issues. And I think that looking at the programme this year, we have met those criteria. We meet at a key moment in the development of European Union policy with the new Commission and the new European Parliament, and several other major developments, such as the single supervisory mechanism at the European Central Bank, represented today by Ignazio Angeloni, a member of the Supervisory Board, and the Single Resolution Board, represented today by its chair, Elke Koenig. It is, however, this year a special pleasure and honour to be able to introduce for the first time in these 12 years a compatriot as a new Commissioner for Financial Stability, Financial Services and Capital Markets Union, Lord Hill, picking up the baton after the McCreevy era and the Barnier era. He has a new and longer title and certainly a fine line to walk balancing his role in a new political context. Stability and prudential provisions became the priority after the crisis of 2008. They remain a special preoccupation, with the capitalisation and resilience of the financial sector greatly strengthened. Capital held by banks is, according to some recent figures, some $500 billion higher now in both the US and the EU than 5 years ago. But marrying that with the need for efficient capital markets supporting growth and employment is also one of the priority challenges faced by the European Union today. And Lord Hill picks up a considerable part of the responsibility for defining and spearheading the response to these requirements, both political and substantive. So with great pleasure, I invite Lord Hill to address the conference. The floor is yours, sir.
Well, good morning, ladies and gentlemen. Thank you, John, for that. I'm very pleased to be here and to have the chance to take part in a conference that I know has become a regular feature of the financial services landscape here in Brussels. As John said, since your last conference, there's been a new European Parliament, a new European Commission, and I hope some new opportunities for the European economy. So it's a good time to talk about new directions for financial services. And I want to talk this morning, therefore, about the direction of the new Commission, the direction that I want to take in my portfolio, the direction of the Capital Markets Union, and a few words about the direction of international regulation. So, the direction of the new Commission. In essence, we want to do fewer things better. We have a new structure of vice presidents, which I think is helping to underpin more joined-up thinking and to concentrate on a smaller number of political priorities. And of those priorities, nothing is bigger than the priority of jobs and growth. And with 24 million Europeans out of work, I think we need to have a real sense of urgency. And that's why our first act, just 3 weeks into the life of the new Commission, was to launch the €315 billion investment plan. It's also why we'll press ahead with free trade agreements like TTIP, and why we're launching a major new drive on the single market in energy, digital services, and my own area of Capital Markets Union. Bigger markets, more competition, more trade, I think, should all help the economy and generate jobs. We're also bringing a new approach to regulation. Just before Christmas, we announced the Commission Work Programme for 2015. And under the leadership of Frans Timmermans, each commissioner had to make the case in front of our colleagues as to why we needed new legislation. The result? This year, we're going to be bringing forward only 1/5 of the amount of new legislation, as was typical in an average year of previous commissions. And we'll also be reviewing over 2.5 times as many existing laws as was usual in the past. And what's more, no commissioner will be able to make a proposal for new legislation unless it's first been signed off by France. So I think we have a number of new filters and checks and balances in place to make sure that the Commission stays focused. As far as my portfolio is concerned, I will try to apply these same principles. In the past years, we've seen lots of new legislation, which was an essential response to the financial crisis and a part of our need to restore financial stability. As a result of that, I think we have much more solid foundations and the European economy is starting to grow again. But the speed of the recovery is slower than we would like. And if the greatest threat to financial stability in the past was the financial crisis, now I believe the greatest threat we face is the lack of jobs and growth. So that's why, like the Commission as a whole, I will think about what I do through that prism. So, fewer new legislative proposals in the future, more focus on bedding in the major reforms of recent years and seeing that they're properly implemented. Thinking about the cumulative effect of different pieces of legislation and checking that there have been no unintended consequences on investment. Making sure that legislation is proportionate and takes into account the different business models that we have in Europe's diverse financial landscape. I don't want to burden smaller, lower risk institutions with the same requirements that we need for bigger, riskier ones. And I think this approach builds on that which the Commission has already taken. So in the Capital Requirements Regulation, for example, we adapted some of the international rules to take into account the specific circumstances of saving and cooperative networks and to make it more attractive to make loans to SMEs. And we took a similar approach in the recent liquidity coverage ratios, where we again sought to reflect the different banking systems that there are across Europe. Looking ahead, I'm keen to build on this policy of differentiation. For instance, we'll need to decide by the end of 2016 whether we should introduce a binding leverage ratio or ratios in the EU. We'll also need to assess the impact of net stable funding ratios on the diversity of business models in the European banking system. In both of those areas, differentiation would be crucial. And beyond that, we'll need to see that the Financial Stability Board's total loss absorbing capacity guidelines are coherent with existing EU rules in the Bank Resolution and Recovery Directive. We'll also need to complete the work started in the last Commission to make the financial system stronger and more stable. The building blocks of the banking union are there, but to be effective, member states need to put those rules into effect. There are also some proposals which are being considered by the co-legislators, notably on money market funds, on benchmarks, on bank structural reform. I hope that they can be concluded swiftly, both to avoid regulatory uncertainty and to strengthen financial stability. My approach to those negotiations will be a pragmatic one. I want agreements that deal with the sources of risk, but do not impede financing of the wider economy. One new legislative proposal I will make is for an effective resolution system for non-bank financial institutions and for clearinghouses in particular. Having concentrated activity into these large financial infrastructures, we need to make sure that we have a framework in place, as there is for banks, to manage their recovery or default. I'm also keen to think about how we can deliver benefits from a single market in financial services more directly to consumers. To think about financial services from their point of view and to identify barriers which prevent them from benefiting from better competition. So in the coming months, I'll be launching a consultation seeking to understand the barriers that persist within the single market and how we might help to give consumers access to more products, better services with better prices. Now, the third new direction I mentioned is building a single market for capital, the Capital Markets Union. Free movement of capital was, of course, one of the 4 fundamental principles on which the European originally was built. So in some ways, this is a familiar direction. But I do believe that at the moment, we have a new opportunity to make progress and get capital markets working better. And if we can do that, the prize would be considerable. To take one example, if our venture capital markets in Europe were as deep as those in the United States, as much as 90 billion euros more in funds would have been available to companies between 2008 and 2013. And just think of the innovation, of the new services, the jobs that could have been created if that funding had been there, the businesses that could have developed and grown in Europe, rather than being developed and grown in the United States. A single market for capital would make Europe more attractive to inward investment. It would create more financing opportunities for SMEs and infrastructure projects. It would encourage more long-term investment. Europe, of course, already has a developed financial network, but now it needs better connections to make that network become faster, more developed and more efficient. And Capital Markets Union is about complementing the role of banks, not displacing them. In some countries, in some markets, bank financing is working well. But in others, it isn't. And where banks are not lending, our startups and our SMEs are struggling. And in all countries, more options for financing at different stages in the life cycle of a business could help boost growth. So my starting point in thinking about Capital Markets Union will be to try to make existing markets work better, to take a number of pragmatic, incremental steps to help get funding to where it's needed most, to long-term investment projects, for example, to infrastructure and to our SMEs. So let me just say a word about what I hope to see emerge in the coming years in each of those areas. First of all, with the support of the ECB and the Bank of England, we want to get the market for securitisation going again in Europe. And I think that this could make a real difference to long-term investment by broadening the investor base to include more long-term investors such as insurers and asset managers. To do that, we're looking at how we could set up a framework for the development of an EU market that singles out a category of highly transparent, simple and standardized products. We also want to support institutional investors to invest in long-term projects. I don't think that it is for governments or indeed European institutions to try to force such a change, but I do think there's a role that we can play in supporting such developments. For instance, insurance companies were given a number of incentives to invest for the long term in the detailed rules introduced for Solvency II last October. We could also step up efforts to create a single market for personal pensions, a 29th regime, which would help to mobilise more personal pension savings for long-term financing. As far as banks are concerned, many of the detailed rules implementing the capital requirements take into account some of the needs for long-term finance. But we'll produce a report under the review of the Capital Requirements Regulation to assess how appropriate the existing rules are. I think that private placements have the potential to offer investment opportunities to long-term investors, and they could broaden the availability of finance for infrastructure projects. And a group of industry bodies recently launched an initiative to encourage the development of the European private placement industry. I very much welcome that, not least because I do not think that we always have to reach for legislation as the first option. I think that the Capital Markets Union should also give us a framework within which we could make a difference to our infrastructure, to the roads, the bridges, the broadband networks that connect the continent. It can do this by providing incentives to institutional investors to put their money into infrastructure. And a couple of examples of things that we're doing. First, the European Long-Term investment funds, or LTIFs, provide an ideal vehicle to provide this type of incentive, both for the new European Fund for Strategic Investment and for insurers. The European Parliament agreed to the LTIFs recently, and I'm very keen to see them up and running as soon as possible. Second, the work of the task force on the investment plan will help increase the transparency of infrastructure projects, which again should make it easier for investors to identify strong projects in which to invest. Our intention is to make amendments to the detailed rules on Solvency II in both these areas, that is, to make provision for LTIFs and to give insurers more ways of getting involved in infrastructure projects. The third area is about SMEs getting access to finance, and again, I think here Capital Markets Union can help. This isn't a new goal, and a number of member states have been active in a number of areas. Some have taken initiatives to try to channel funding more effectively to SMEs, and we're looking at the experience that has been gained under such schemes. But if we can get it right, the benefits of doing this at a European level could help us to generate valuable multiplier effects. We'll also be focusing on SME lending in our forthcoming assessment of the impact of capital requirements, and in the context of international standards, we'll argue that particular attention should be paid to the appropriate calibration of SME lending capital requirements. Banks, I think, could help in one area, namely in giving better feedback to SMEs and pointing small businesses towards alternative types of financing when they consider that a loan is not right for them. Other SMEs, I recognise, may want to have other options, like listing on a growth market or attracting venture capital. And I think we need to help raise SME awareness of alternative financing opportunities. Companies that decide to take the plunge and offer securities on a market should not be deterred from doing so simply because of the amount of paperwork involved. And that's why we want to revise the Prospectus Directive so that it becomes easier for SMEs to fulfil their listing obligations, but in such a way that investors are still well informed about what they're buying. And we recently launched a consultation on this, and we look forward to getting practical advice on how we can make things work better. Although there is good basic information out there on companies and what they do, potential investors can't easily assess the credit risk that they might present. So we'll also look at whether there is a way of increasing standardized data for credit assessment, again, without tying all SMEs up in a new tangle of red tape. We're considering how we could boost the ecosystem in Europe for venture capital, and that might include adapting the rules for European venture capital funds and the European social entrepreneurship funds to expand the categories of fund managers able to offer those funds. So in just those three areas, I hope you will agree that the Capital Markets Union project offers us an opportunity. An opportunity for banks as important intermediaries of market-based funding. An opportunity for investors to increase their options for investment. An opportunity for Europe to widen access to new channels of funding for SMEs and infrastructure projects. An opportunity, in other words, to finance growth. Building a single market for capital will be a long-term project. It's ambitious. It will not be easy. We're going to have to revisit some age-old problems with fresh eyes. But I believe there are also some areas where we can make some early progress, identifying barriers one by one, and then working out ways to knock those barriers down. To do that, I'll need the input of member states, parliamentarians, but also from investors and those who want investment, European businesses which want to grow. This long-term project, we're going to need to build step by step from the bottom up. And my plan is to come back later in the year, setting out an action plan with more detail of those next steps. Finally, I just want to say a few words about the international picture. Having a vibrant EU market that attracts capital from outside is essential, as is the ability for businesses to operate globally under coherent regulation. When the crisis hit, world leaders put the G20 at the forefront of a coordinated international response. It was the FSB which established the core elements of a new global financial system. In the EU, we've supported that process, and we certainly know the importance of international consistency. Nevertheless, those international rules and standards are not always very detailed, and they have to go through the democratic legislative process in each jurisdiction. We need to ensure that the detailed domestic rules work well together. Loopholes and overlaps will not provide stable and resilient financial systems. They make life difficult for global businesses, they impose costs on them, and they create opportunities for people to game the system through regulatory arbitrage. And that's where the work at bilateral level can come in. And I think that the level of interconnectedness between the EU and the US in particular means that that relationship is especially important. And that's why I believe that we need to create a closer and deeper regulatory partnership through TTIP. I don't want or expect identical regulation, but better cooperation would give us the framework within which to consult each other at an early stage in the regulatory process. By implementing international standards in a consistent way and by having close supervisory cooperation, the EU and the US would be able to rely on each other's rules as long as they achieved the same outcomes. And that is surely in the interests of both EU and US markets, and it's important for financial stability. It would mean we could provide a larger and more efficient marketplace for financial firms, giving them greater capacity to provide finance for the economy. Early troubleshooting and greater supervisory cooperation would mean that we could maintain financial stability more efficiently and solidify the leading role of the EU and the US in financial regulation. So based on the solid foundation of financial stability that's been built up in recent years, I do believe that we can look to the future now with a greater degree of confidence. The 4 new directions that I've talked about today, a new direction for the Commission, my own approach as a new Commissioner, the Capital Markets Union, and the need for international coherence and consistency in financial regulation, those 4 directions all come together to deliver one overriding objective: creating the right conditions for jobs and for growth. That's the objective which will be at the forefront of my mind as I go about my job, whether that's completing the financial regulatory framework, developing new proposals, thinking about the international dimension, or building a single market for capital. That simple objective, that clear lens, is the way that I will approach everything I do. And in the 4.5 years that are now left of my mandate, I look forward to working with you and organisations outside this room in making progress on those objectives. Thank you very much.
Thank you very much, Commissioner, for that stimulating opening of our conference and a very interesting overview. It's an honour and a pleasure to now introduce Antony Jenkins, Chief Executive Officer of Barclays, one of the major financial figures of European finance, to give our second keynote speech today, and for his second appearance at this event, we appreciate very much him making the time in his busy schedule to come and talk to us. I'm not going to take time by repeating Mr. Jenkins' CV. It's in your packs. You can all read. It's a very distinguished background, but it's worth noting that he stepped into the top job at one of Europe's large banks at a key moment in the development of the culture of that bank, and has made progress in that culture a defining element of his tenure. So we look forward with anticipation to hearing what he has to say today about our main topic, the new direction for financial services and the role financial services can play in helping to shape a new direction for our economy. Mr. Jenkins, the floor is yours. Thank you.
Commissioner Hill, ladies and gentlemen, it's a pleasure to be here in Brussels with you this morning. Much has changed since I was here a year ago. We have a new European Parliament, a new Commission, and renewed energy at the heart of Europe, as we saw in Commissioner Hill's speech a moment ago. I'm not going to dwell on the past, except to note the depth and breadth of reform that I've seen in recent years. That was important work. We only need to look at the measured reaction of the financial markets to recent events in Greece to understand that Europe has become much more resilient. And now, under President Juncker and Commissioner Hill, we are looking to the future and to the question of growth. That's why Barclays is delighted to be co-hosting the annual European Financial Services Conference, now in its 13th year, and coincidentally in the year of Barclays' own 325th birthday. We're proud of our longevity. It gives us a unique view on some of the challenges that we face. We've now made loans in 5 different centuries. We were making venture capital investments in the early 1700s, although of course it wasn't called that. But this makes us optimistic rather than cynical about the potential for change. It makes us aware of how long some of our most pressing problems have been with us. Over-indebtedness, short-termism, excessive exuberance, these are nothing new, but they do need to be constantly managed. Humans as a species are fundamentally conservative. When we are faced with a challenge, our first response is to try and fit it into our existing models and ask if that model is the right one. Our minds are much better at picturing the world as it is, rather than as it could or should be. The will to genuinely innovate is a gift. Most of the time, that makes complete sense. After all, most technologies are the product of 1,000 small improvements, and they're advancing the agenda forward rather than a huge leap of imagination. But it becomes a problem when the model itself is broken. That was the case after the financial crisis, and arguably even before it. The simple truth is that the old economic settlement didn't work in its own time, and certainly won't work in ours. We have often been guilty of seeing the global challenge in terms of what worked in the past, asking ourselves, how do we restart the housing market? Where do we find new business debt? These questions seem reasonable enough, but in so many ways they're about the old model, not a new one. They assume that debt and asset bubbles are just part of the cost of doing business. And they say nothing about the new competitive reality. Like President Juncker and Commissioner Hill, I am more interested in 3 alternative questions. Where will growth come from? How will we fund it? And is the next generation ready? I believe that by answering these questions, we can lay the foundations for a new model, an innovation economy able to compete in the post-crisis world. First, the question of where growth will come from. I'm delighted that the new European Commission has put growth and jobs right at the centre of its work. There is a clear ambition here at the heart of Europe to address barriers to long-term growth. We have to make progress if we want to counter the populism that we see all over Europe and to build trust in the concept of a reformed market. People have every right to query the current economic settlement. It is our responsibility to put forward an alternative proposal for growth which they can support. It's very important to note that we are now in a period where GDP growth globally is going to be structurally lower than it was, and combined with long-term demographics, there is a potential for constricted economic performance over a long period of time. Success won't come to us automatically, and growth is no longer a right for the developed economies. It will have to be earned. I believe we can and will succeed if we approach the next few years in the right way. We have to support the army of SMEs in our economy, but we also need to be smarter about how we identify and incubate innovation. And we have to rethink employment in an automated world. Some new businesses which are founded to commercialize innovation will go on to thrive. But more often, innovation happens in a business with a long-term track record and the cash reserves to give that idea every chance of succeeding. In fact, most high-growth businesses are older than 5 years rather than younger. Our focus should be on innovation and entrepreneurship, and we shouldn't mind where we find it. I'm fascinated by the emerging changes in the business market. Increasingly, value creation in high-margin goods is separated from where the physical manufacturing happens. Consumer electronics are a good example. Western companies found a way to compete at a time when the market was largely dominated by low-cost Asian innovators. They realized that the thing they are selling, their competitive advantage, is the design of the product, not the manufacturing process. The kit is built all over the world, in a dizzying journey through Africa, Europe, Latin America, and Asia, and to a high quality. But the real innovation happens at their domestic headquarters, where designers create premium products and branding which consumers are willing to pay extra for. That's where real value is created. It is a powerful new model for the EU economy, and the implications for our workforce are obvious. We will see skilled jobs created here, but automation and international supply chains will have an inevitable impact on less skilled work. This is an opportunity as well as a challenge. We could stroll towards an employment crisis, or we can completely rethink our education and training for the next generation. We all agree that the trade environment is crucial to the competitive landscape for EU companies. I admire the energy and skill the EU is putting into building trade agreements with the world. We are, of course, at a very important juncture in the negotiation on the Transatlantic Trade and Investment Partnership. Barclays supports these efforts, and we hope that regulatory cooperation in financial services can be part of the final package. The ability to trade successfully relies on the ability to compete, so we need external consistency of our policy choices. This will mean coordination with other jurisdictions. One of the reasons I stress the need to include financial services in the Transatlantic Trade and Investment Partnership. And it will mean not implementing ideas that will put our own businesses at a competitive disadvantage. To give you an example, it is clearly counterproductive to pursue a financial transaction tax which directly reduces the competitiveness of our markets against our US competitors. But we also need internal coherence. Reform to our sector has to support the wider goal of creating a sustainable economic footing. Capital requirements and market reforms are important for investment banks to operate safely. But we have to be careful that we do not stifle the exact parts of the market that we're going to rely on most in coming years. Secondly, the question of how we will fund growth. An innovation economy will be development intensive. That requires finance, and finance of a particular nature. And unpopular as a statement it is, there is no material gap in funding for SMEs as a group. Many banks are in fact not capital constrained, and in the UK right now, we have the lowest cost of borrowing in recorded history. We and many of my competitors have sufficient capital to respond to a rise in demand. In fact, the amount of lending to SMEs by high street banks is now back at its average level and never fell more than 4% below it. So I do not see a gap in the market for SME debt. If we could see one, we would fill it with the capital we have at our disposal. But I do see a gap for risk finance of all ages and stages, which is particularly acute for smaller businesses. We will hear later from Xavier Rollet. I know he will agree that the new innovation economy will have to lean heavily on capital markets. I'm delighted to see the Capital Markets Union proposals, which come from a similar understanding. We are right behind the Commission's initiatives for securitisation and private placements, which are important in their own right and will provide us with momentum. But the real change has to come from the addressing the much more traditional challenge of matching market risk and reward. Ultimately, we're returning to the equity gap. We would like to see the creation of a pan-European market for venture capital. We have used the phrase pre-capital markets union. It is our way of describing an approach to the sort of patient risk finance for smaller innovators which the EU would benefit from. At the heart of the challenge is harmonising venture capital schemes to make it easier for businesses and investors to find each other across borders. At the moment, it's very difficult for a business to raise their first round of venture finance in one country and the second elsewhere. And that seems self-defeating. We believe that soft harmonisation should be entirely achievable. Finally, I want to return to the most acute deficit we face, and that is the deficit in skills. The new innovation economy will be knowledge intensive. It is a unique opportunity for us. We can improve our experiences as customers, and we can drive up productivity. Take my own sector. Automation is nothing new. Barclays introduced the first cash point in the United Kingdom, and we introduced the first credit card. I promise you, we will continue to innovate as an organisation. So automation has always been part of our journey, and today is no different. Low-skilled jobs like processing checks can now be done more quickly and accurately with technology. And we can pay each other using nothing more than a mobile phone and an app. I'm sure some of you use these innovations yourselves, and I know I do. Just as I do most of my shopping online, or travel on the tube and pay for my coffee using my contactless credit card. And I buy technology which is only possible through the combination of phenomenally skilled engineering and automated manufacturing. This is the reality of how we behave as consumers. The march of time is towards an innovation economy, an economy built on technical skills like science, technology, engineering, and mathematics. But the education system in so many of our countries are not producing these skills. We can just amend the old model and produce a generation of young people ready for an unskilled economy which is fading away. That will inevitably lead to mass unemployment and low productivity. Or we can take the braver path and give our young people the skills the innovation economy will demand. Skills like code programming. At Barclays, we're aiming to establish 100 coding clubs by the end of 2015. And we've created a training programme for young people called Barclays Code Playground to introduce them to the basics of coding. Vocational training is just as important. Apprenticeships can be a powerful way of starting young people on skilled careers. We have a very successful apprenticeship scheme at Barclays. In fact, one of the most important ways that we hire new staff. 3 years ago, we committed to employing 1,000 apprentices by the end of 2015. By 2013, we have beaten that target, and we've set a new one of 2,800 apprentices by the end of the year. By 2020, we expect to have reached 6,800. These apprentices get paid the UK living wage and have a real career development route, which includes professional qualifications and our graduate level training schemes. I'm sure that many other businesses represented here have their own equivalents. And we shouldn't forget the skills needed to be an entrepreneur. We support 120,000 new startups every year at Barclays, but we need to reduce the failure rates. At the moment, only 3 in 10 businesses make it to the 5-year mark. So we believe that skills like business management, marketing and accounts should be part of the mainstream curriculum to give young people with an innovative idea the best chance of being a success. More businesses starting up is one thing, more businesses staying afloat is another. To conclude, I cannot overemphasize the responsibility our generation has to give the next one a chance to prosper in the new economy. Europe is at a crossroads. One path leads towards low growth and a future of unmet demographic challenges. The other path is towards sustainable growth and an innovation economy. It's a choice between making amendments to the old model or having the will to genuinely innovate. I am confident that with the leadership of President Juncker and Commissioner Hill, as we heard today, we will make the right decisions. I know that our speakers here today have a lot of wisdom to share with you on these topics, and I thank you all very much for listening.
So many thanks indeed to Mr. Jenkins and to Commissioner